So today we're talking about now infrastructure, right? Like really infrastructure from the perspective of scalability. I think this is everyone's favorite topic. You love to come up with an idea, and then somebody in the room loves to be like, but how does it scale, right? And everybody's stumped. No one can figure it out, right? I think that market is very different now. I think we figured out those problems. But really, what does it mean to scale real-world assets, right? I think it means compliance. I think it means institutions. We have to acknowledge that at this point. I don't think anyone's pretending it's a retail-only play. And it means new users, honestly, users that we don't have on chain, right? And so we've got kind of an interesting crowd here, which are working on the infrastructure side of things. They're focused on scalability, solving that problem, enabling the next generation of users. So I'll turn it over to you guys to introduce yourself and start with Charlie and just go down the line.
Hey everyone, I'm Charlie Yu, the CTO at RWA.xyz, the leading data analytics platform in the tokenized asset space.
Hey guys, Jeff Kuan. I lead enterprise initiatives at Axelar. Axelar is an interoperability network. We connect over 50 different blockchains today and enable cross-chain communications between these chains.
Hey, I'm Steven Goldfeder, co-founder and CEO of Offchain Labs. Offchain Labs does a few things. Primarily, we're known for building the Arbitrum technology stack. Arbitrum is the most widely adopted and used layer 2 platform on Ethereum, and also builders of Prism, which is the leading consensus client for Ethereum layer 1.
And last but not least, I'm Anthony Moro, CEO of the Provenance Blockchain Foundation. We are a Cosmos-based layer 1, and we are the largest public blockchain as measured by real-world assets.
Certainly not least, 2 networks, 2 infrastructure providers, a bridge, a data infrastructure provider. Pretty interesting group, right? So the topic again, scalability, infrastructure, real-world assets. I think we have a lot of users in the room. We have a lot of builders in the room. I'm curious to get the perspective from you guys. Like, when it comes to tokenization today, what's like the single thing you think of that makes the biggest difference for RWA users, RWA builders as they're coming in thinking about this? Charlie, you want to kick us off? We'll go down the panel again.
Sure, and I think it's a great question. And my answer is that there's one thing that I know at this point it is not, and that is that institutions at this point don't care about a lot of the technical specifics of the L1 and L2 wars that we like to engage a lot on Twitter about. And we talk to a lot of institutions and investors in tokenized assets in our seat as a data provider. And the last thing that they care about on the list is what blockchain it is on. A lot higher on their list is it a good quality asset? Can I get my money out? Is this legal? And so I think if we do talk about what the answer is on what is needed for the space, and it may sound a bit obvious, but it is volume, and it is bringing people on chain and getting them to transact. That drives fees, drives the entire industry, pays for everyone's jobs in this room.
Yeah, I mean, I completely agree with that. I think maybe another problem that is pretty prevalent is like the UI problem, right? So right now, just getting access to real-world assets, whether they be on Provenance or any of the other L1s, is it's not like entirely easy. And I think trusting large institutions to go through the DeFi flow of getting assets on one chain, bridging it to another, and then on-ramping onto Provenance is not great. And so I think building kind of better flows, user flows, to make it easy for people to on-ramp into these structures is pretty important. And I think we're doing a lot of work with the Provenance team and as well as others to enable some of these experiences.
Yeah, so I think there's a ton of interest now. If you look back past few years, ton of interest has moved to moving some of these real world assets onto the public chains like Ethereum, like Arbitrum. And I'd say the top 2 problems that I've encountered were, one was scalability, which is a lot of these asset providers have real, not just the smaller by comparison communities that we see on Twitter. They have actual ton of users, and they're concerned about the success. And what happens if the thing succeeds? How do we scale? Right? Does it scale? And even if they're going to start off slow, they always want to make sure there's a path to scale. So I think that's problem number 1, and that's a problem which we've largely solved today with layer 2 solutions like Arbitrum. And the second one that we're seeing now pop up a lot is compliance, which we've mentioned. And is it legal, or how can you do these things? And this is something which we have a product called Arbitrum Orbit, which allows you to launch your own chain in customizable ways. You can put your own fee token or a stable coin as a fee token. It allows you to sort of take the core technology, have the security of Ethereum, but also implement your compliance logic. So I think this is a relatively new development, but one which we're seeing a lot of interest in to help solve these compliance issues, because also compliance isn't the same everywhere in the world. Many different solutions will need, many different providers will need different solutions, and it also gives them the customizability they need. So I would say scalability and compliance are the two main problems we see from, at least from my layer of the stack.
And just before we get to Anthony, like you said something I think was pretty interesting there, right? 24 months ago, 2 years ago, maybe even a year ago, you talked about like path to technical scale, and it seemed like we had so many problems. Who knew we were going to solve it? The merge hadn't happened. There was maybe 1,000 different potential solutions. Didn't really know, but you said pretty explicitly like we do have those solutions now. Do you think that's fair to say?
Absolutely. I think, today it's funny, like the biggest problem like pops up and you solve it, the next one comes. So I think scalability is very much a solved problem today. Now it's a cat and mouse game. What I mean is you scale and then more users come, then you need to make sure you meet that adoption. So you never like fully scale forever. But I would say that's not the problem in the foreground now. Problems around like usability and how do we onboard users to use these wallets and have these best experiences, and compliance, which is closely related, I think are much more in the foreground today. So I think we've scaled for now, and now we need new applications to come and use the block space we've created because we have an excess now. And I'm excited to get to the point where we need to scale again. And we're doing it in real time, so hopefully we never actually hit that point. They're moving together. But yes, I would say so.
Love it. Anthony, back to you. What's the biggest thing you think makes a difference?
I think there's three. I think it's asset quality, risk profile, and then UI UX. And all three of them need to come together in a market, in a specific asset class to make that asset class worthwhile. And they need to come together at the same time, which is very difficult, right? So I'll start with asset class or asset quality. And the first one I'm going to talk about is what Figure and several other partners have done in the home equity line of credit space. So the yin and the yang is a mortgage, cash out refinance when interest rates are low. You don't do that. You do a home equity line of credit when interest rates are high. So two sides of the same coin. That market is, in I think my opinion, and fact-based, the first and only real-world asset market that has been disrupted by blockchain. We talk a bit about stablecoins. We talk a bit about tokenized money market funds. The scale of those markets are, frankly, very, very small compared to what Figure, Guaranteed Rate, Movement Mortgage, HomePoint have all done in the home equity line of credit and mortgage space. And I'll give you an example. When you go to figure.com, you can sign up for a home equity line of credit in 5 minutes. You can get a decision in 5 minutes, and you can get your funded in 5 days. Now, that's largely a Web 2 experience. When that loan is written, it's put onto the Provenance blockchain. And then when they go to warehouse and securitize it, they bring 150 to 200 basis points out of the cost equation of that because it's cheaper, faster, and safer. You have cryptographic proof of the loan. And when you go to sell it or securitize it, which Figure has done several times with actual rated securitizations underwritten by Morgan Stanley and Goldman Sachs, you take that 150 basis points out of the equation, you can give it back to the homeowner in terms of lower rates. So if you're in the mortgage space and you're not using blockchain, you've been disrupted already, you just don't know it. Now, the rest of the market's going to be taken asset class by asset class. And as I said, all three of those things need to come together at the same time, which is really hard.
I actually think that's a great, I want to challenge you a little bit on this, right? I said I would, so Anthony knows about it. He's down to play the game, right? But I think it's a good question. It's a bear market. Everybody's asking, where are the institutions? We've been hearing that they're coming since 2017, and here you are telling me how much, 150 basis points. I mean, are the institutions stupid? Where are they? Like, why aren't they here? Like, what is the problem with that?
So $15 billion, it's not going to retail. It's all going institutionally. Every single piece of, I would say paper, right? In the old world, every piece of paper that you write, every digital asset that you produce is being bought by large institutions. And they've done now 3 rated securitizations. You go to Morningstar, you can see the AAA rating. It's institutional assets bought by, it's a small number, right? So $1 billion in the real world is a very small amount of money, right? You need to get to that scale before you get the pension funds and the big institutions. So unless you get to that scale, you're talking retail. So we're not a retail chain right now. We might be in the future. But when you sell a $300 million ABS, it's to 12 institutions. It's really not to 1,000 institutions, right? It's 12. So they're there.
They're there. They're there. They're on Provenance. That's the pitch, at least, right? Okay, so Sergey, we were talking about this on the panel prep call as well, right? You were looking at, or you guys have both been looking at, Axelar and Arbitrum. You guys have both been looking at working with institutions to bring them on chain, right? That's kind of the question. Same kind of question I asked Anthony. I'm curious, maybe how do you look at how that happens from an infrastructure perspective? How do we actually bring the institutions into this environment? What are the ways you think about bringing that, that go-to-market almost, right?
go. I think maybe like 2 points. So Anthony, we were talking about this earlier, but I think one of the points that you made, which was pretty interesting, is that a lot of the existing RWA users in crypto are not crypto users, right? And so we see, there are a lot of like institutions coming. There are a lot of people that are actually using these products. They just might not be the same types of people that are using like Uniswap to swap between like two like ERC20 tokens on Ethereum. So I think kind of like bifurcating the market and thinking about those different user bases, I think is important. And then I think on the second piece, like, just having better like Rails and infrastructure, compliance, UI, I think that will bring on a lot of kind of the rest of the institutions and a lot of like existing people that, when we think about like a big bank or some of these players, like that's what they're waiting for, right? That kind of better infrastructure to make it easy for them to onboard and kind of compliant and safe way, which is what they care about.
Yeah, I'd say also that, there are definitely, you have to compartmentalize the class of users, but also, if you look on chain today, like a year or two ago, no one on chain was interested in, say, a money market fund coming on chain because the yields on chain were just like much, much better from like the Aave and the DeFi products than from the traditional money market funds. There's a massive opportunity there today. So Franklin Templeton recently announced that they're expanding and moving to Arbitrum for their money market fund. So I think it's both. I think we'll bring new users on chain with that. I think we'll bring many new users on chain. They're doing incredible work by both being innovative and being a first mover, but also doing a lot of the paving the regulatory pathways to do this, which is no small task and no small feat. And they're like Franklin and others like them are very well positioned and have these relationships to do that and actually push us along as an industry. And I think it's both the new users they'll bring, but also there's a ton of capital on chain, and there's billions of dollars on Arbitrum One today, and that capital is if the compliant paths come through and we have to figure those out, how they can access, say a traditional money market fund, I think that capital, a lot of it is ripe for the taking as well, particularly in the current market conditions.
Yeah, I mean, there's a distinction between building for users who think there's an efficiency here, right? 150 bips of transactions for them. They are buying this stuff. They do see opportunities there. But then there's a distinction for building for users who are just absolutely desperate to use it, right? Trapped capital on chain, doesn't have access to treasuries because they're a DeFi native organization. No broker dealer will onboard them. And we have kind of a class of users or products being built for that market as well. I'm curious, anyone here on the panel, it's kind of an open question, anyone wants to take, like, when you sit in your seat and you look at the world, do you think about the distinction of DeFi versus TradFi? Do you follow that pretty strongly? Is it merging together for you? What do you think about that?
So I think a lot of the discussion that I've heard here today is crypto transitioning to real world. And that's the wrong way to look at it. If the crypto asset base is $1 trillion in value, the real world, and I hate the word real world asset, Charlie and I were talking, so I'm using it, but I hate it. It's $500 trillion. So what market should we focus on, the $500 trillion or the $1 trillion? Yet 80% of the conversation at these events is on the $1 trillion. It's how to get the $1 trillion into a money market fund. Well, replicating an offline money market fund and just tokenizing it really doesn't do anything. It's really double the risk and double the fees. So I don't really see the benefit of that. If you could do it digitally native, and JD from Rcoin is here somewhere, he has a proper 40 Act registered fund, he's doing it the right way. It hasn't scaled yet. It will hopefully soon because it's a better product. But that's the kind of thing where it's digitally native, one master cap table on one blockchain that can use a network like Axelar to bridge into other places. Makes a ton of sense. And just my PR guy will kill me if I don't mention that we had a press release this morning. We're formally integrated with Axelar today. So congrats, Axelar.
Yeah, looking forward to working with you guys.
To add on one more thing to what Anthony was saying is that you can, if you think about what fundamentally will get a traditional finance institution to actually invest in the space, you drill down all the way into the asset level, and you think about if you have an equivalent asset in TradFi, equivalent asset that is tokenized in DeFi, an investor will always choose the one that has a better risk to return ratio. And at the moment, it's just a reality that tokenized assets have more risk than their traditional finance counterparts. And so back to the 150, 200 bips. Now, if you can pass that on to your investors, like you're clearly doing with HELOCs, then I think this is sort of the pathway to a lot more of rational institutions coming on chain and seeking out tokenized assets because the risk to return ratio is better because of those reduced costs and efficiencies.
Look, moderators' powers, I get to share my 2 cents whenever I want, so I will, because I like this discussion a lot. Like, I think it's all the innovator's dilemma, right? You can bring 150 bips out of the equation, but because of the risk that you're talking about, there is more risk. There's new counterparties, new technology risk people aren't aware of. It's so different from where the value chain of existing institutions are, it's almost impossible for them to come on board. And so what does it take? It takes...
I got to challenge that one. So the latest figure securitizations were rated AAA, just like a standard asset-backed security under the same criteria. The difference between these ABSs and TradFi ABSs were these assets are all digitally created on blockchain. So I think it's cheaper, faster, safer. And because of that, you're able to show value back. If you just take an existing off-chain asset and you tokenize it and put another fee on top of it, that doesn't do it. You need to recreate the market, digitally native ideally, and bring it there.
I actually fully agree with what you're saying. I mean, we're not saying the wrong thing. We are saying the same thing. I do think this market is better if you bring it on chain. You can make it more automated. It can be more transparent. We'll get to that in a second. But it's just difficult to get existing legacy incumbents to move the new infrastructure, right? And so the go-to-market has to be different and has to come from first movers who don't have some of those legacy attachments and have the ability to be a little more independent. But those are kind of the institutions in my head. Institution's also a terrible term, right? While we're talking about naming, real-world assets is a terrible acronym. Institution's a terrible acronym or word. It just means too much. We overuse that context, but whatever, right? Moving on, so part of the infrastructure and scalability conversation here, we talked about it a little bit on the stablecoin panel when we talked about transparency, but there's a lot of this which is just like data, right? You get so much more data when you move on chain. That's what the point of building a network is. That's what the point bridges are trying to solve, of taking advantage of data that exists in this network and move it over to another network, right? And Charlie, you guys are building data infrastructure. And one of the challenges we always hear from institutions is, I want my data private, but then one of the benefits we hear of blockchain is that makes the data public, right? You're building in the space, you're trying to kind of navigate the chasm between private data and public data. I would love to maybe hear your take on that and how you kind of imagine that working out, and how do you solve the problem? What do you think about it?
Yeah, I would say that in general, we have a very fun job where I sit, in that we're able to sort of get a data-driven view of everything that's going on and expose where the sort of crypto industry isn't necessarily looking where they might want to be. For example, there's been a big trend around tokenized treasuries after we sort of shed light on a lot of the different 6x, 600% growth that was in the industry very recently. And that is one of the beautiful things about blockchains, where we don't have to go to Franklin Templeton and Wisdom Tree to actually pull that data and rely on them in order to get that. We can actually just go on chain. It's all that metadata is already there, and we can show that to the world. And in theory, anyone can go and get that. And so I think that's one of the things that originally attracted me to this entire space, was the transparency. You watch movies like The Big Short, and you hear those stories. Some people live through it, and there's in their careers at least. And I was able to really resonated with me that the mission of DeFi, where you're able to potentially prevent something like that because you can see the debt built up in the system and be able to prevent it. And so that's the sort of mission that really drives us, is preventing that in the future with transparent data.
I think also another thing to mention is transparency is great in many situations, but like the fact that you're going on the blockchain doesn't have to mean that everything is completely transparent. Privacy technology exists, and in some contexts it's like a bad word to say that, and I don't, there's many different flavors of privacy technology, and they can help with compliance in some ways as well. We've actually seen, it's interesting, over the years, privacy technologies haven't done that well actually in the blockchain space, and I think some of them were ahead of their times, and some of them still exist. Others, there is a graveyard of different teams trying, I'm not going to name them today, but that have come a little too early and trying to build this sort of from the startup perspective, like, hey, we're going to build compliant, private liquidity pools on a public network. And I think they were ahead of their times. I think a lot of what you need is the real world asset, the institutional interest in these products, and I think now we're seeing that. I imagine we're going to see a resurgence in privacy technologies, but just to anyone here building, you should know it's not necessarily this binary, which is like, if you're on the blockchain, everything must and always will be public. That is the default on a public network, but there's definitely room to build privacy technology. And I mentioned one product that we have is Arbitrum Orbit, which allows you directly in the network to build your own chain that has customizable cryptography or privacy tech in the chain. You can sort of build it in a compliant way and in a privacy preserving manner as you wish. And again, I think We came from the wrong direction as an industry first, trying to build the technology before there were users. Now we have the users, and a lot of them we're having, I'm having conversations with, want privacy tech, want KYC-enabled tech, and I think we'll see a resurgence and a deeper interest in those building this technology, and it does exist and can exist.
Yeah, I mean, it's interesting to think about building technology before users are there, and then actually trying to go out and get those users to come now that they are here, right? Like, that's a core problem I think we had for so many years, and I think we're solving that. I don't know if you guys would agree, but it does feel like we're getting a better idea of what the market is like for, or what's interesting. Like, Anthony, you mentioned it exactly, right? HELOCs are a great market to disrupt, right? It's like kind of a nice stepping point to step in there, do your thing, create a nice market that is better, prove you can, and then step into other markets. I'm curious if you guys have any, maybe points you want to call out as interesting use cases or interesting markets that you guys are seeing as like the next thing, right? Maybe it's not tokenized treasuries. I'm curious to get the take from the panel here.
Yeah, so I think we're seeing two types of users, either very small startup, seed and A round companies trying to build the figure of X, whatever that X is, whether it's, we have a home equity investments, we have a life insurance product, we've got receivable products all coming on chain, but they're all generally smaller. And then the other side of the coin is the biggest banks in the land. And they're all doing some really interesting things also. And a lot of it revolves around tokenized deposits, but also some of the larger banks are doing proper funds with very, very large investors. And then you have the problem, do you keep it on your private permission chain, your internal bank blockchain, or do you recognize the future? And I think the guy from Texas Teachers earlier said the future is public, and I fully agree with that. But it's not today. So how do you make that transition? And it's an Axelar bridge from a private bank blockchain to a public network, keeping control of the entire transaction the entire way, and that's a first step. And then from there you can build.
Yeah, digging more into like the Axelar bridge part of it, right? The Axelar perspective. I kind of see a lot of this as being driven by the innovation in DeFi. I said this on the last panel that I was moderating. You are a bridge company. You sit literally in between these two different networks, the private network or the institutional network or the very niche focused network, bridging back into the on-chain capital markets, right? You want to talk about maybe the importance of on-chain in the DeFi world and the relevance of that to this whole institutional conversation?
Yeah. So I think in the first year or two of Axelar, we were really focused on our beachhead market, which was DeFi, right? Because in order to sustain as a business and generate transaction fees for the network, like we need to go where the users are, which was all on chain on DeFi. I think, and people used bridging technology for different things, right? There's simple asset bridging, but there's also kind of interesting use cases that are forming around what we call general message passing, which is sending messages back and forth from different chains, which kind of preserves a lot of the kind of security requirements and keeps like assets like on their home chain. And there's a lot of like really interesting applications that have kind of leveraged GMP technology. We're starting to work with a lot of enterprises, large institutions, banks that have these private chains or private to public chains that are also starting to leverage a lot of the kind of experiences and like the user flows that we've built out in DeFi and applying that in an enterprise context, right? And so some of what we do is pure asset bridging, but a lot of what we do is more sophisticated like general message communication between these private and public networks. And I think that that is kind of a natural evolution of a lot of the work that we did in DeFi.
Today feels like an interesting time to be working in this space because, on one hand, we have like Provenance and Figure saying, hey, the institutions are here, they're building on our work today, right? On the other hand, we have Arbitrum, billions of dollars of capital of brand new kind of innovations, new tech that we haven't seen before, frankly, new users that weren't typically a user class in finance, right? We have kind of the bridge between the two worlds. Charlie, you're talking about kind of the opportunity that's here at almost like a holistic level when you have data that's available and you can build that type of transparency, right? I mean, I don't think I'm wrong for saying that I think this is kind of an inflection point. Like this, honestly, the attendance here, the kind of vibe and energy we see here today is really where we're starting to see the mix of the right people in the right rooms to start building towards, I think, of like the Gen 2 use cases in DeFi, right? I want to go down the panel and just ask, like, what's the most important thing, or not most important, maybe what's the most exciting thing that you're working on right now that you think will unlock the next big thing for you guys in the next 6 to 12 months, right? Something you're working on today. You can show yourself, but everyone finds that boring, so make it useful.
We are always focused on our main mission of being the best data platform in crypto, period. And we want to be able to have all assets, and soon to be Provenance and their HELOCs, and everyone else in this room, if you want to get your asset listed, hit me up. But so that's the biggest thing that we're working on. And so soon in the next quarter, you'll be able to view all on-chain activity, hopefully all real-world assets on our data platform, and want to start extending that into more private data as well in the future.
Yeah, I think for us, there's probably two things we're working on that I'm excited about. One is distribution for asset issuers, right? So we work with a lot of stable coins, tokenized, U.S. Treasury type products, soon, Provenance products, and helping to give distribution to some of these products and meeting users where they are, right? Whether they be on a Cosmos chain or Ethereum or whatever, I think being able to create distribution for these products is extremely important and something that we're spending a lot of time on. And then, the second piece, as I spoke to earlier, is around improving the UI around these sorts of experiences, right? Being able to make it easy for people to access, creating the right structures so that large institutions feel safe, and having them being able to interact with these sorts of solutions in a compliant way.
Just real quick follow up on that. When you say you're a bridge protocol and you talk about building or improving the UI UX, right? I would typically think the applications is actually doing the UI UX part, but you're a bridge and that is kind of where the friction points are. Can you talk about how you think about improving UI UX and what's important to you there?
Yeah, so the bridge is the underlying technology, but a lot of what we do is work directly with applications to build these experiences on top of the Axelar stack, right? And so I think part of the beauty of using Axelar and a lot of these other bridging solutions is that you can customize the technology in such a way to make, to create these user experiences that are kind of catered to whatever end users you have. And so a lot of what we do is actually less with end users directly and more with other protocols themselves.
So Arbitrum technology is, in DeFi, the leading platform, the leading technology for innovation in DeFi today, and it's super exciting to see bridging these two worlds, the real-world assets and the on-chain assets. You mentioned Franklin, and also just this morning we did an announcement with Centrifuge. Centrifuge is bringing their liquidity pools to Arbitrum 1 as well. And what we do is also try to bend the technology we build to the to people that are building it, to the development. So I'm a technologist, so I'll talk about technology for a second. Two other things, some people's eyes may glaze over, I'm sorry. But one thing we're doing is something called Stylus, which is this new really cool piece of tech that we recently announced and released, which allows blockchain contracts, smart contracts to be developed in traditional programming languages like Rust, C, and C++. Now that may sound boring to you, but if you talk to your development teams, the ones that are actually tasked in these institutions to build these products, they probably don't have much of, say, Solidity background, which is the leading EVM language. They probably have Rust and C and C++ and traditional language capabilities, and the libraries and code they've written already probably also work in those languages. And we firmly believe in how do we build the technology and bend it to the users and not make the users bend theirs. So there's a big focus in the public blockchain space on the EVM. Arbitrum is EVM compatible, the most compatible, and it will always be. That's the Ethereum virtual machine. But to us, that's the floor, not the ceiling. Because if you zoom out and you say the world of Solidity or EVM developers is about 25,000 people. The world of Rust is about, Rust developers about 3 million. C, C++, 12 million developers. And a lot of those developers are going to sit in your institutions. And that's where their expertise is. It's not only developers, it's the code that they've written. You say to someone, hey, you can come on chain onto the public network and you can actually use your legacy code. That's going to be massive for people. And it's also going to be massive for building up privacy technology, because a lot of the libraries, like the cryptographic libraries required for that, and for compliance and KYC, your KYC backend engine, they can do that on chain. And just they can speak to each other. That's pretty cool. So that's, I think, the most exciting thing we're doing from a technology perspective is making our technology accessible to institutions and institutional development teams. And we're seeing a ton of interest when it comes to the actual business teams and financial teams that are interested in it. And we're doing work on the back end to make once that aha moment happens, you say, okay, we want to build this to make that as easy and seamless as possible in a way that I think no one else is integrating sort of EVM and traditional language support today.
And Arbitrum has been like predominantly, like I think one of the defining characteristics is really developer focused, like building roots with developer communities, really strong DevRel, really like kind of getting people to use it and build it. So this is almost like the institutional adoption path through the development team, right? Through the back office in a way, right?
Absolutely, and some of this, like this is to some in like the pure blockchain DeFi space. What I said is heretical. Like, how could you ever support anything but the EVM? But like our thoughts are, it's plus EVM plus. We're not the EVM support, the Solidity support is not going anywhere. We have to realize and we have to zoom out and look at where the rest of the world is. And we want this, as Anthony said, we want this to remain a $1 billion or $5 billion or $10 billion asset class, or do you want to open it up to the others? And there's lots of different parts of the stack to make that possible. And we have the job that we have is building the infrastructure. So it's kind of boring. And then we have to do the work to get people building. I mean, it's not boring. I'm joking, but it's kind of interesting. But we can do what we can to make those paths available, to make it so once others want to build on it, it's the easiest and most seamless path that they can, and they can import their legacy code in a way that really allows them to do great things and at low cost. High throughput, that's one of the biggest things we see from real-world asset. Like, what's the transaction throughput? Can we scale to my user base? And, we're constantly trying to answer that question with yes and doing better and better and better and, building the technology rails to meet the demand because, it's clear, like you said, from here today, just looking at the crowd, the demand is here, the demand is increasingly coming, and we need to do the work ahead of time to make sure that we can meet it.
I mean, there's nothing like a bear market to wipe out ideology, right? There's no ideology in foxholes or bear markets, I think, right? But Anthony, what's the most exciting thing you guys are working on today?
Yeah, so I'm going to paraphrase Willie Sutton, the bank robber, a little bit. We're going to tokenize bank deposits because that's where the money is. There's the Regulated Liability Network 2.0 here in the US, replicated in the UK, replicated in Switzerland. On Provenance has been the USDF consortium for a while now, trying to get through regulatory purgatory, but they're just about there. As you can imagine, they have to ask for permission for everything they do, and that's the way it should be. But the regulators are just allowing this genie out of the bottle a little bit if it's done properly, and properly for them is very private, very permissioned, no token. It's almost the opposite of crypto. But because if you build it on Cosmos, you have the ability to spin up a Provenance, you have the ability to spin up a private chain, which is interoperable back with mainnet at some point in the future when we're ready to do that. So we can meet all those requirements and get them started, but that's how you get $1 trillion of assets on chain. It's with the banks. The banks need to be a part of this ecosystem. They absolutely do. It's where the deposits are. If the banks get disintermediated by, for instance, a yielding stable coin that was a security, watch deposits leave pretty quickly, right? So that is also coming. I'm not going to talk about it, but it's coming. But banks need to be a part of it. The RLN is a great construct. If you don't know USDF consortium, do take a look at it. They're doing things the right way. But that's how we get the next $1 trillion of real world assets on blockchain.
I mean, we're talking about new users, actually. I would love to give you an opportunity to plug USDF just a little bit, right? Because my understanding is it's really kind of not taking maybe the biggest banks in the room, but actually the smaller middle market banks, giving them an opportunity to have a playground or a sandbox or ultimately real rails they can use to go to market, right?
Yeah, great. So I'll take it. It's 13 smaller regional banks who are all bought in on the concept of blockchain. They all have very large bills for Fedwire and ACH, as you can imagine, and very slow payment and settlement times between each other. And if they had the ability to use a common ledger, Provenance in this case, it would significantly lower costs, significantly increase opportunities for real-time payments with their customers, give them an edge over their competitor banks. It's just, again, cheaper, faster, and safer is what I keep coming back to. If you can solve cheaper, faster, and safer all at the same time, you're going to win in financial services eventually, because you're going to disintermediate traditional players. Now, there's a lot of resistance against it, of course. But if the banks can get together, and they're starting to, and agree on a commonality, on a common format, and the Regulated Liability Network had a sandbox test 1.0 last year, 2.0 is coming now, it's a bigger, broader group. I think blockchain can start to change the banking rails and keep US banks solvent, keep the US dollar as the dominant currency globally, because if all on-chain money is dollarized, right, it's only a good thing for the US.
Look, I promised the planning team I wouldn't talk about anything regulation after lunch and put people to sleep, so I won't ask about the regulatory update there, but I think I'll open it up for questions again. If I've got a guy running a mic, he can run it over to you or stand up and shout. I'd love, topic panel again was infrastructure, scalability. We spent a lot of time on institutions and new users. What questions do you guys have? for the panelists. Don't be shy. I think you guys answered every single one. I love it when that happens. Oh, here we go. One question, please.
Question for Stephen. So with Stylus, how do you think about security when you're introducing new programming languages to Arbitrum? I mean, there's a lot of sort of battle-tested Solidity code concepts with regards to smart contracts and transmitting values. How do you think about security there?
Yeah, so actually, it's a great question. The question is how do you think about security with Stylus? Stylus is this product I mentioned that enables you to write code on the blockchain. I'll say here we have real-world assets and real-world programming languages. Some may be offended by that, but the question is actually you can do a lot from security and actually get you to a better security state. So for example, one of the biggest, there are two big, there are many, but there are two big areas of security vulnerabilities that enter via blockchains, like Solidity and EVM, like traditional smart contracts. One is bugs that creep in because people try to really super optimize their code. The reason they do this is because the languages aren't that efficient. And you can shave off some costs, some gas costs by just really optimizing and sort of getting rid of some safety features along the way and not writing code. No, traditionally when you write code, you want to write the cleanest, most readable code. But here you want to write the cheapest code, and those two things are often in contradiction. It turns out when you have like C and C++ and Rust compilers that have just years of development behind them, you can do, the compiler does a lot of work for you, and you can write safe code that is just by default going to be very efficient. And so you don't have to take some of those readability hits in order to get the efficient code. That's one, which I think is an underrated but very important benefit you have here. A second is we've actually designed the system with security in mind. So one of the other big issues when it comes to smart contracts is reentrancy. And actually in Stylus, reentrancy is disabled by default. So your contract will revert by default if it detects reentrancy. And in Solidity and EVM languages, this is just super expensive. So it actually gives us the ability to, I think, write safer, cleaner code, and hopefully and also utilize libraries that are existent already. You don't have to rewrite things in Solidity. You can have your backend talk directly to your front end as well. I think are all opportunities to write better code, and ultimately, I think I'll have a safer, more secure experience.
Any other questions? Alex, please.
It's 5 years from, question for everyone. It's 5 years from now. Wave a magic wand. What is the thing that you're proud to have achieved or caused others to have achieved?
It's a great question. I'll repeat it. It's 5 years from now for all the panelists. What is the thing that you're proud you have achieved at then? Think about the future.
The term real world assets is dead, and it's just assets.
I think bringing institutions on chain and really, increasing the adoption to a point where it's not just like a niche group that's talking about these technologies. And actually, part of the irony is, like a product like I build will probably go into the background as you get main adoption. Like no one cares about the bottom levels of the internet stack. It's like, I'm using IP and HTTPS to order my Uber. It's like, no, I'm just ordering an Uber on my phone. Like, what are you talking about? And that's actually ironically, like me seeding into the background and my product seeding into the background, you just using it and not knowing, but actually not realizing it is going to be, I think, a metric of success.
Honestly, that's kind of the same, right? We're an interoperability network. Like, end users shouldn't have to know that they're using Axelar under the hood. Like, we should be ubiquitous, and hopefully in 5 years, I'm out of a job and Axelar is just massive.
For us, if our partners, the protocols, the infrastructure, the L1s in the tokenized asset industry, if our partners succeed, then we almost succeed by default as well. And so we really want to bring the entire industry together, working with folks like Centrifuge here and the rest of the tokenized asset coalition to achieve that and to get the next $1 trillion on chain.
Well, I'll just say, if you think about it, ledgers, which is really all we do at the end of the day, it's a ledger. It went from a piece of paper to an Excel spreadsheet to an on-premises data center to a cloud data center, now to blockchain. That's really at its core all that we're doing. And you don't talk about paper ledgered assets. You don't talk about cloud ledgered assets. So why would we talk about blockchain ledgered assets? There's assets.
I do love that, by the way. Real world assets is never used again. I hope it's not 5 years from now, by the way. But just one more question over here.
Yeah, thanks. Question for everybody. There are a ton of private chains, and there are obviously many public chains. How do you think about the intersection between private zones on public chains?
I think that, well, bridging here is obviously very important. And so you will have a world with many, many networks. I think we'll see consolidation over time to verticals. An analogy that I like to use is like TV channels. Clearly, like not every show has its own channel, but clearly like you need more than one channel. So I think we'll see some verticals emerge with their chains. And I think bridges will always play an important role. But at least in the short and in the foreseeable term, the experience of being on a single chain will be more seamless for like synchronous composability and doing things in one transaction than even the best bridges. And that's not, there are great people, and we have one here on stage, like building bridges, but I think we're not at the point yet where the multi-chain interactions are as seamless as the one chain. So I think there still is a strong place to have on a public blockchain like Arbitrum 1, a zone where, hey, you can actually here's a compliant zone on the blockchain, but you can actually go across that boundary much, much more smoothly. We have seen companies like Clance is a company, for example, that's building something similar, for those familiar, like a permission KYC zone on the public blockchain. So I don't think these two things are in contrast. I think we need the best bridging technologies, but at least for the foreseeable future, there will also be good use cases for having some of this on the public chains directly.
And I'll just add, banks and larger asset management firms are absolutely committed to private zones and sandboxes right now. I've got a friend at he's a top 10 asset manager. He's the head of blockchain for a top 10 asset manager in the world, and they call him Bitcoin Boy, right? It's not ubiquitous yet, guys. We're not even anywhere near that in traditional financial services. So the first place they're going to operate is a private blockchain or private zone of a public blockchain. But I think everyone also agrees, even Bitcoin Boy agrees, and his colleagues agree that the future is public.
Yeah, I think, just to kind of echo the points here, every single large enterprise that we are currently working with is operating their own private chain. I think the state of the world, 5 to 10 years from now is probably one where every company has their own private blockchain where they store their own data, and then those private blockchains have some way to interoperate or interact with either other private chains or public chains where some percentage of that data or some forms of information are shared, but a lot of it is kind of kept within their walled gardens, right? And so I think, obviously I think interoperability is important here, but I think the future is probably some balance of a lot of private chains and some public chains.
I think that there's an additional distinction to be made in the public versus private distinction here, where you also need to consider, I think permissioned versus permissionless is an entirely other dimension of the story that gets missed in the public versus private, where, of course, Provenance, a permissioned but public chain, whereas you have others like, Arbitrum, which is permissionless and public. And so don't have anything more to add on the terms of an opinion there, but I do think that there's what we hear from a lot of our partners is that, eventually in the very long term, everyone likes public chains. They're sort of a Schelling point for consensus. But the permissioned versus permissionless story still has yet to be played out.
I love it. Thank you for the questions. I think we're going to end it there. Let's give a round of applause for our panelists. This is a great discussion.